Hi everyone, hope you've had a great week. We're moving on to chapter 8. This is the last chapter before exam 2. You'll be happy to know this chapter's not super complicated. Some of it are things that you've done before, some are some new things. But this chapter is all about current liabilities as we're still moving down the balance sheet. I want to run through 4 or 5 examples here, and you can refer back to these as often as needed. So the first one talks about borrowing money and paying interest. This is essentially the same thing you did with notes receivable, only the flip side of that. Instead of interest income, now it's interest expense because this is a liability, remember. So we're talking about this company that borrowed $60,000 cash from the bank and signed a 3-month 7% note payable. Interest is payable at maturity. That's an important statement because that tells us they're not going to pay any interest until they pay the whole loan back. And their year end is December 31st. That also tells us that there's going to be an adjustment for interest at December 31st. So the first thing we want to do is record the note payable by aviation training. So aviation training borrowed money, so they actually got cash. And they got $60,000 in cash. So we'll debit cash $60,000. They owe this. We're going to post that to notes payable, which is a liability. In this case, it's a current liability because it's a 3-month note. And I want to go ahead and put these in the accounts. So 60,000 cash and notes payable 60,000. That was the first thing. The second says record the appropriate adjustment for the note on December 31st. So we have to adjust for interest expense because they have incurred some expense during the year of 2021 that we want to put in 2021. So we're going to debit interest expense and we're going to credit interest payable because they aren't actually paying it yet. They're going to pay it 3 months after they borrow it. They're not paying it at December 31st. They're paying it at January 31st, the next year. So this is an important calculation because a lot of students just use a 3-month, they split the 7% into 3 months. So take 7% divided by 3. You want to be careful because interest is always in terms of 1 year. That's what APR means, annual percentage rate. So the principal times the rate times the time in terms of 1 year. So the principal is $60,000. The rate is 7%, which is 0.07, not 0.7. 0.7 is 70%. And then you multiply 60,000 times 7%, and you come up with a year's worth of interest, $4,200. So you take that $4,200 and you divide that by 12 months. That gives you an amount per month. So $4,200 divided by 12 gives us $350 per month in interest expense. So the interest expense at December 31st, they had it from November 1st to December 31st. So that's 2 months, the whole month of November and the whole month of December. So the interest expense is the $350 times 2, or $700. So interest expense, we're going to post it to the account, $700. Interest payable, $700, because remember, they're not paying it yet. Now at January 31st, they're paying the whole note plus all of the interest. So we need to reduce notes payable, and we need to debit it to reduce it because it's a liability. So we need to debit it $60,000. We're also going to pay this interest here that we accrued at December 31st. So interest payable, debit $700. But they also have another month's worth of interest here in January that we haven't recorded yet. So we do have some interest expense for the month of January, and that's just 1 month of interest, so it's $350. And the amount they have to pay altogether is the $60,000 plus the $700 plus the $350, or $61,050. Not $60,000 plus $4,200, because the $4,200 is the whole year's worth of interest. So we would post the $60,000, and I'm going to highlight that. Let me put that in red. That would make our balance to this notes payable 60,000 minus 60,000, and make it 0. Our interest expense, an additional $350 for January. We're debiting our interest payable for the $700 that we owed. And we're crediting cash for $61,050. So this is basically the same as a notes receivable, except it's the flip side. It's a notes payable and interest expense instead of notes receivable and interest revenue. Okay? Payroll is one of the probably the most common current liability for companies. Let's just talk just for a minute about payroll. So when you get a paycheck, your paycheck has gross wages. That's what you earned per hour times the number of hours you worked. So say you earn $100. You don't bring $100 home. You bring something less than $100 home because taxes are withheld from it. The tax that's withheld for everyone is Social Security and Medicare tax, and it's sometimes called FICA. You see that here, FICA. That's Social Security tax and Medicare tax together, 7.65% total. 6.2% for Social Security and 1.45% for Medicare. There are some limits and ceilings and floors for those things, but we're not going to get into that in this class because this is not a payroll class. Then you might have state income tax and federal income tax withheld. That money that's withheld from your paycheck does not belong to the company that's withholding it. That belongs to you. When you file your taxes at the end of the year, they're withholding it in advance to pay your taxes. So it's important to understand that the federal and state income tax withheld from your paycheck does not belong to the company. The Social Security and Medicare that's withheld from your paycheck does not belong to the company either. It goes into your Social Security fund with the Social Security Administration. So these are all liabilities for the company. When it's held out of your paycheck, it's a liability to them. They don't get to keep it. They get to expense your gross salary, and everything that's withheld from it is withheld on your behalf and sent into the proper agencies with your name and Social Security number attached. And then many times there will be some money withheld from your paycheck for your portion of the health insurance. Again, that's your expense. That's not the company's expense. You're paying it. So, in addition to all of that, so that's your paycheck less everything that's held out of it. In addition to that, the company a lot of times will match or pay a portion of the health insurance on your behalf. That is an expense to the company. That's called fringe benefit. And then for payroll taxes, whatever gets held out of your paycheck for Social Security and Medicare or FICA, same thing, the company has to match that and send it in with your name on it. So that's an expense to the company. If you're self-employed, you have to pay both halves. You have to pay your own half, as you normally do, and you have to pay the employer's half. So the employer must match it and send it in on your behalf. There's another payroll tax that companies have, and that's state unemployment tax. And it's different rates. It depends on the employer's experience rating and a number of things. But state unemployment tax is not withheld from your paycheck. It's an expense for the company. In case you become unemployed through no fault of your own, company shuts down, goes out of business, has to lay you off, you can collect unemployment benefits from the state because the employer paid in on your behalf. There's also a federal unemployment tax, but we're not going to get into that one. So how do we record this in the books? There are 3 steps. And as long as you remember these 3 steps, it will be fairly simple. The first step is to record the company expense. So we're the company. During January, they incur employee salaries of $3 million. Withholdings in January are $229,500 for the employee portion of FICA, $450,000 for federal income tax, $187,500 for state income tax, and then $30,000 for the employee portion of the health insurance. So all of those things are held out of the employee check. And then the company incurs some additional expenses on their own. They incur an additional $186,000 for federal and state unemployment tax and $90,000 for the employer portion of health insurance. So first we're going to record the company expense. And it's salaries expense. In this case, the expense to the company is $3 million. They get to expense your whole gross salary. But you don't actually get the whole gross salary, so what comes out of it? Well, FICA comes out of it. FICA, which is Social Security and Medicare. FICA tax payable, and the company doesn't get to keep it, so it's not theirs. It goes into a liability account, and that's $229,500. In addition, there is $450,000 for federal income tax and $187,500 for state income tax. So we'll put that in an income tax payable account because the company has to send it in on your behalf. Remember, it's not theirs. So that's the $450,000 plus the $187,500, $637,500. In addition, there's $30,000 for the employee portion of health insurance, and it says payable to Blue Cross Blue Shield. So we'll put that in accounts payable because presumably the company has received a bill for the health insurance, and those are accounts payable items. So $30,000. So this gross salaries less all of this stuff withheld is the amount that's actually paid to the employee. If it said paid, we would put cash, but it says salaries payable. So we will credit salaries payable. And this is the amount that your check's actually written for. So it's the $3 million minus the $229,500 minus the $637,500 minus the $30,000. So this is net pay, $2,103,000. Second, we're asked to record the employer-provided fringe benefits. So remember, fringe benefits are like the health insurance or perhaps retirement benefits. So here, and this book puts it in salaries expense. Typically, companies would probably use an account called health insurance expense or something to that effect, but it gets lumped into salaries expense for our purposes. Remember, the employee paid $30,000 of it, and we recorded that, but the company incurs an additional $90,000 for the employer portion. So $90,000. And it's payable to Blue Cross Blue Shield, the same as the other one was. So we're going to put that in accounts payable. So that's the second step. Third step is to record the employer payroll taxes. This is actually payroll tax expense. A lot of times you make the mistake of thinking that these numbers up here that come out of the employee's check are payroll tax expense. They're not. That was on behalf of the employee with the employee's money. So payroll tax expense will be debited, but what are our items that go there? Remember, we're the employer and we have to match FICA. So we're going to have a FICA tax payable. And it's pretty simple because it's exactly the same as the amount that came out of the employee's check because we have to match it 100%. $229,500. And then they paid $186,000 for federal and state unemployment tax. Again, this does not belong to the employer. Unemployment tax payable. This is a current liability for the employer. $186,000. And so the total of payroll tax payable is the $229,500 plus the $186,000, or $415,500. That's the tax expense for the employer. These are all liabilities, and they're all current liabilities because the corresponding agencies, the Social Security Administration and IRS for income taxes, and Arizona Department of Revenue for income taxes, and the state unemployment tax companies, don't allow the employers to hold this stuff. There are strict rules about how long they can hold it. They cannot withhold this almost $1 million from your paycheck and use it and then send it in months later. There's actually, for bigger companies, there's a 2-day banking rule. So it has to be transferred electronically to the agencies, the taxing agencies, within 2 business days. So that's payroll. Remember, 3 steps. First, the company expense, the total salaries and everything that's held out, and then the employer, the company fringe benefit expense, and then the employer payroll tax expense. If you remember those 3 steps and don't do 2 of them in 1 step, it doesn't work. There's 3 steps there. You'll be fine. Okay, another current liability, gift cards. When companies sell gift cards, that's not revenue because they have not provided any goods or services yet, other than this little card that says it's worth $15, $25, $50, whatever. So it gets posted to unearned revenue. Unearned revenue, if you remember right, or deferred revenue, is a liability account. So they're talking about Apple here. They sell iTunes gift cards, and they sold $21 million in gift cards in November. And then customers redeemed 14 million of those gift cards in December. And that's probably pretty accurate, maybe even more. So we're asked to record the advance collection of the $21 million. So the company received cash for these, $21 million. It is not revenue yet. It is deferred revenue, which is a liability account of $21 million. And we're going to go ahead and post that. 21 million to cash. Oops. Formatting, sorry. So we're going to debit cash for 21 million and we're going to credit deferred revenue for 21 million. See how it gives this Excel? It's just saying there's not enough space there to display it. So we open it up a bit. Okay. So now we have the company has $21 million in their deferred revenue account. We want to record the revenue recognized when 14 million is redeemed in December. So in December, those gift cards were cashed in and customers received products. So we've earned the revenue at this point. So we will debit deferred revenue, reducing it by 14 million. We will credit sales revenue because we earned it now, 14 million. So let's post those. So our deferred revenue is 14 million that we've earned, leaving us a balance in this account of 21 million minus 14 million, or $7 million that we still have in outstanding gift cards. We've also earned this 14 million in deferred revenue. So we're moving it to revenue. And then the third question is, what's the ending balance in deferred revenue? Well, it's $7 million because we started out with 21 and they collected or used 14 million, so that leaves 7 left. So gift cards are unearned revenue or deferred revenue. Okay? Sales tax. Sales tax is another current liability. Sales tax, when you go into a store and you buy something for $100, you probably pay more than $100 unless it's food for home, which in some cases is taxable and some it's not. Mostly it's not. So if you buy a product at Best Buy or something and you pay $100 for it, I'm not sure you can get anything at Best Buy for $100, maybe. You're going to pay $100 plus sales tax. The sales tax is collected by the company, the retailer. It is not theirs. They're collecting it on behalf of the state and local agencies, and they have to submit it to them in a timely manner. So it's a current liability for the company. So in this case, the company makes a $3,200 credit sale. So they made a credit sale, a sale on account. The state sales tax rate is 6% and the local rate is 2.5%. We're asked to record the sales and the sales tax payable. Well, if it's on account, we're going to debit accounts receivable. For how much? Well, $3,200 plus tax is how much they have to get. So the sale is $3,200. The tax rate is 6% plus 2.5%, or 8.5%. 3,200 times 8.5% is $272 in sales tax collected on this 3,200. So they're going to receive 3,200 plus 272, or 3,472. Not all of that is revenue. Sales revenue is only $3,200 because their sale was $3,200. Sales tax payable, current liability, is the $272. So this amount does not belong to the company. only the 3,200 of it. So what happens if a company doesn't charge enough sales tax? They still, so say they collected $240, not $272. They would still have to remit $272 to the taxing agencies. What if they collected $290 and they should have only collected $272? They do not get to keep the excess. They must give that to the state as well, the state and local taxing agencies. Okay, one more. So warranty liability. So a warranty is a contingent liability, and they talk about contingent liabilities in the textbook because the liability is contingent upon something happening. So a warranty is a contingent liability because the payment of the warranty expense is contingent upon the product failing. So we've got a Sony introducing a new CD player to compete with Apple's iPod that carries a 2-year warranty against manufacturer's defects. So based on industry experience, warranty costs are expected to be approximately 3% of sales. By the end of the first year, total sales are $31 million and actual warranty expenditures are $300,000. But we don't record actual warranty expenditures as an expense. We want to match what we believe we're going to have to replace because remember, it carries a 2-year warranty. If it carried a 1-year warranty, we could just do actual, but it has a 2-year warranty. So we have to record all of the expense we expect against that $31 million in the year of the sale. We're going to debit warranty expense for 3% of 31 million. So plus 123 times 0.03 or $930,000. We're going to put that in a warranty liability account. $930,000. So let's post that. $930,000 posted to warranty expense, debit, and $930,000 posted to, oops, I knew I had an extra zero, posted to warranty liability, credit, which increases it. At the end of the first year, they have actual warranty expenditures of $300,000. So we're not going to debit warranty expense because we've already accounted for the entire 3% of the 31 million. Actual warranty expenditures will be posted to the warranty liability account. And that's $300,000. And they probably paid cash for it, so we'll credit cash for $300,000. Let's post those. So warranty liability, $300,000, cash, $300,000. So what do they report on their balance sheet as liability at the end of the year? The balance in the warranty liability account. So $930,000 minus the actual warranties of $300,000. So they expect another $630,000 in warranty cash to paid out for warranties by the end of the second year. And every time they sell this product, they're going to book a warranty expense. So again, warranty expense, warranties are a contingent liability. And you can look at the rules for contingent liabilities in your textbook. Okay, that's all I have for you on this chapter, these few quick examples. Again, if you have questions, don't wait to post in the discussion until the night before everything is due, because I can't help you then. Although the class is doing pretty good at helping each other. So if you need anything, let me know. Have a great week.